As widely expected, the Bank of Canada held its key interest rate steady at 2.25%, its last decision of 2025. Joining me now to discuss the latest decision is TD economist Maria Solovieva. And Maria, what's your reaction to the decision? Any surprises for you?
This was one of those decisions where you can sit back and relax, put your feet up, grab some popcorn, and enjoy the show. We knew that the most likely decision will be a hold, and Governor Macklem was very prescriptive in the previous statement that this is where he thinks, and the Governing Council thinks, that where the economy is in kind of a steady state, and it warrants the current rate of 2.25, which is at the lower range of the neutral rate. Okay, so given this decision, does this mark the end of the Bank of Canada easing cycle, or is there a future rate cut a possibility? Well, actually, the market is pricing in a full hike by the end of next year, by October 2026. And it has come down, that pricing has come down a little bit. But we have to thank the very strong jobs report last week to that. And indeed, it was a very nice surprise to see unemployment rate come down to 6.5%. And just remember that September was 7.1%. Yeah, so this was quite unexpected. The economy added more jobs as well. So the markets kind of got ahead of themselves and priced in a more hawkish stance. But today we've seen the reaction in the opposite direction, with the two-year yields coming down a little bit, that pricing adjusting a little bit as well. So we would probably say that right now, where we are currently at that, that rate is where we should be, and I think the Bank of Canada is of the same opinion, and most likely we're going to hear this today with at the press conference as well. So it's interesting that the pricing in hikes. We still have a big uncertainty right now, which remains the tariff negotiations between Canada and the United States. What happens if we don't get a deal? What impact could that have on monetary policy next year? So we have it as a status quo right now. There is no deal. We haven't implemented anything. Going in a more of direction of a better deal than the current stance, or worse deal than the current stance. So obviously, this is a risk. But I'm afraid that the Bank of Canada can't do much about it. And again, they've been fairly clear about the fact that the tariff negotiations and tariff war in general is not something that they can lean against. So for them, this cycle is a little bit unusual, right? And we also agree with that you do have your typical slowing demand and your typical attributes of a typical cycle. But at the same time, you also have this headwinds that the Bank of Canada is just simply not equipped to deal with. So unfortunately, even if there are some changes in the trade stance and to the worse, the Bank of Canada just simply won't be able to do much about it. So we think that they will remain just vigilant and watching some of the measures that are coming out out of the economy. Now, one of the reasons why the Bank of Canada might be kind of sitting on the sidelines is we got the 2025 federal budget, which is now public. How do you see that playing out to help backstop the Canadian growth in 2026? We have implemented just a little bit of a boost. We do think that the budget is a nice first step in the right direction. There are definitely a lot of things that need to be done, and the government is trying to reorient the economy towards more trade with East-West versus South-North. And that's a very difficult task, right? So there are some elements that we definitely welcome, some tax incentives, broadening out of tax incentives that are hopefully will make it a positive towards next year, and mostly going forward as well. But we think that there is more to be done, and we're hoping that some deregulation, potential changes to taxes as well, little steps that will help make Canada more competitive. There's obviously a little bit more work to be done also on the industrial level, like working with the companies, working with industries, understanding their needs as well, and trying to help them out. So there is way more work to be done, and we still need to see how this is going to play out in 2026.
Okay, so let's talk about currency. Given this latest decision, how do you see the loonie performing going forward?
So it's funny because we actually did see a little bit of a boost to the loonie just recently because of this expectation of a rate hike or just a little bit higher pricing of that. This was probably just too premature, but going forward in 2026, we do expect a bit of a stronger loonie. Just on the margin, and that comes from the interest rate differentials. As we expect the Federal Reserve to cut rates, and Bank of Canada kind of staying on the same level. The price of the loonie will also improve, and that's what fundamentally we think that's the appropriate 73, 74 is where we're expecting it to be U.S. cents per Canadian dollar.
Okay. Okay, so now going forward, what indicators do you think the Bank of Canada will be following closely as they, as they prepare for the next rate decision in 2026?
Well, inflation is clearly one of them, and the bank already stated in today's statement that they would be looking at looking through most likely some of the upward pressures in inflation due to the HST tax last year. So the base effect will play out in the next couple of months. So they will be cognizant of that and not necessarily react to that. So definitely inflation and our expectation as well is that it will gradually come down to the target level of 2%. Definitely inflation expectations of what consumers and businesses are expecting going forward, and I think so far it's moving in the right direction. There is a little bit of upward pressure because of the tariff narrative, but I think overall it's fairly balanced. And then, of course, employment. This report, for example, that we saw last week for the month of November, it was actually showing more a stronger economy, stronger job market. It will be interesting to see play out because some of this strength is actually coming from part-time jobs, right? So it's not necessarily the fundamental strength that you would want to see. So they would be looking at the job market and supply and demand. And from the supply perspective, we're actually expecting flat labor force next year. So that. Even if there is a bit of slack in the jobs market, you could actually still see favorable environment for the unemployment rate. So this would be interesting to see, but the devil is always in the details, so they'll have to really dissect it to make sure that they understand the fundamental drivers of the economy.